Hi, everybody. Welcome to Andromeda's Credit Macro Webcast. I'm Hope Wood, the head of business development, and I have with me today Alberto Gallo, Andromeda's CIO and co-founder, and Adi Ani, a PM and co-founder. And today we're going to be discussing the outlook that we see for markets, which we recently wrote about in our outlook note, the silver bullet, no free lunch for the Fed. We'll also be discussing markets more broadly and how we are trading those from a portfolio perspective. We have time for questions at the end, so please feel free to add questions into the chat. And we will be roughly 30 minutes total for timing, with leaving some questions at the end. So with that, I will hand over to Alberto.
Thank you everyone for joining and for your time. We're definitely navigating a complex environment, even given the events over the past few days. So in the next 15-20 minutes, we're going to go through our macro outlook on growth, inflation, and geopolitics, and discuss some of the opportunities that we see in the second half and that we are picking up in our strategy. So let's start with a brief idea of where we are with respect to growth and inflation, which has been, the key theme this year. Very simply, we expect, no recession and no cuts. There's been a lot of, discussions about an imminent recession. We don't see that, but we also see sticky inflation. Lagarde used the word persistent or persistence 13 times in her last speech. And so inflation is driven by demand here, not by supply bottlenecks, which have faded. And we'll see more of that demand in the second half of the year. There is stagnant growth, especially in some countries, and in the manufacturing sector, we're experiencing a technical recession, and that's true for Germany as well as for China. In China, there is a balance sheet recession. People have too much into housing, too many savings into housing, and that's why consumers are not consuming enough. But against this backdrop of growth that is still positive, inflation that's sticky, and any slowdown is not strong enough to cause weakness, enough weakness to create the room for cuts. Against this background of still solid growth, the real elephant in the room is, what are central bankers not doing? Why do we had 500 bips of cuts in the US, we had almost 400 bips in Europe, and inflation is still sticky? And so the answer is, the elephant in the room is quantitative tightening. And we've done a lot of analysis on the inversion of curves. And essentially, interest rates in the short end are not doing enough. Central bankers are doing only half of their job. And the question around quantitative tightening, so the balance sheet and yield for control for the Bank of Japan, will come back to bite them in the second half when inflation will remain sticky. And once you're getting to target in the short-end rate, we think that will be the driver of potential fragilities in the financial markets in the second half. And we're going to go through some of the things that we think might break if the long end goes higher from here. So I think after Sintra, it's pretty clear that there is no cuts this year. And, we're going to start pricing, especially after the data that we just saw this week on growth in the US and consumption just coming out, a few minutes ago. We're going to start pricing 2 hikes this year for the Fed. We also have central banks that are well behind the curve, like the Bank of England, that have surprised with 50 bips, and there might be another 50 bips at the next meeting in August. And pretty much, all the central banks that have tried to pause were punished by the market. Think about the RBA, for example. So we continue to see a flattening, a disinversion of the Fed curve. And in particular, we're looking at 2024 for more disinversion, for more essentially higher for longer. The 2023 disinversion has already happened. Against this higher for longer policy reaction function, a lot of people and some markets are much more concerned about weakness, particularly the dovish bias continues to stay strong in rates markets, after to 24 and 25. But are these cuts justified? And essentially what we are seeing here is that after the very big shock that we had in March with Credit Suisse and SVB, demand is coming back and is picking up strongly, especially through the summer. There is a very interesting paper by the Kansas City Fed, which talks about shocks, and the shocks in the system that come from financial markets, are absorbable. They're not permanent. So it's a bump in the road. It's not a permanent damage to the economy. Lending is coming back. The housing market is coming back. Rents are coming back up in the US. So there's no need for cuts here. And there's, if anything, need for more hikes. And inflation in particular is coming from increasingly from the core part of the services, the wages, which are going to take longer to normalize. Obviously, we are not at the emergency levels of inflation that we were before, but the question is, where are we going to stabilize? And here, our colleague Tao Pan, who heads research, has done a lot of work to understand the path of inflation post the base effects, which will fade after July. And so one of the drivers for market and risk assets is inflation, and then the reaction function. And inflation, we think, even in a scenario where oil is stable around $70, is going to be between 2.5% and 4%, which is the green distribution that you see there. Obviously, with higher commodity prices, we might see higher inflation, and that in part depends on some of the geopolitical events and the war in Ukraine, which we'll discuss later on. But even in a base case scenario, benign scenario, we still see inflation above target with a median of around, in the green distribution that we see, so low oil prices still above 3%, which is enough for the Fed to definitely not cut and probably do, a couple of other hikes between now and year end. Now there's countries that have other problems. If the Fed has the willingness and the ability to hike, we have other jurisdictions where there's less ability to hike, like in the UK, for example, where households and the government have increased debt levels. So here the central bank has a much more difficult choice, which is hiking and creating a property and a credit crunch in the economy, or staying behind the curve and letting inflation run, hurting consumption, hurting the bottom 50% of the population, which is what they've done so far. Now there has been a shift in the Bank of England. We do expect the shift to continue, but they do remain behind the curve, and we think it's very hard for them to catch up. They'll need to go at least to 6%. And stay there for longer. But again, the curve inversion that we see across all yield curves is playing against this. So we expect that even with a terminal that's currently at 6%, we expect the inflation data in the UK to stay sticky, and we expect more volatility in the real economy due to the higher for longer policy that the Bank of England is joining a little bit late. Against some of these points in developed markets, we have seen a lot of weakness in emerging markets. While developed markets are worried about excess inflation, in emerging markets there's a slowdown in China in particular, and so the PBOC has been easing, and there's been a lot of discussion around targeted stimulus. We're skeptical, and the reality is we're skeptical because we still see that large chunks of the Chinese economy are in a balance sheet recession. Consumers which have the highest savings ratio in the world, have heavily invested in property, and that bubble will take a longer time to diffuse itself. So even though the Chinese government has essentially been able to detach part of the liabilities from the property sector through defaults in the dollar market, there's still a lot of liabilities which remain in local governments and in other areas of the financial system in China, which are still there, and together they make up over 250% of debt to GDP. So we think that the way out of this will continue to be low rates, a weaker yuan, and potentially some more weakness in local governments. And this is one of our medium-term trades. We don't see a shock there, but we see a long process of debt adjustment in China, in the private sector and in the semi-public sector. So what's the elephant in the room? Well, we had 500 bips of hikes from the Fed, 375 from the ECB, and over 400 bips by the Bank of England. And so why is inflation still sticky? Well, either we have a scenario where inflation will continue to go down to 2%, or like the data is showing us, it's going to stay sticky, and particularly core inflation, as we have seen in Germany today and in the Eurozone and in the UK. So why is inflation still sticky? Well, it's not about supply, it's about demand, but also because until the long end of interest rates goes higher, investors are not really encouraged to shift their preferences. In other words, you can raise the short end to 6 to 7 to 8%, but who really borrows in the short end? Unfortunately, who's borrowing in the short end are small businesses and people that have more need for cash, that use credit cards and auto loans. But what really matters for long-term investors, for large companies, investment grade and high yield, and generally for 70–80% of the economy, is the medium and long end part of the curve. So until we see treasuries below 4%, Microsoft and Apple can essentially run a carry trade. They can invest in T-bills at 5% and borrow at 3.8 plus a tiny spread. And if we think about it from the perspective of consumers, then what happens is that if you're keeping yield curves inverted, and this is a very complex simulation that Powell has run, but essentially in an environment where you're only raising the short end, you're making the rich richer. So you're not lowering demand. You're hurting parts of the economy, but those are the parts of the economy that need already short-term funding, that have less assets and less cash. So the distributional impact does not really reduce asset prices substantially unless you convince the market that you're going to keep interest rates higher for longer. And that's something that the Fed has only done recently. But again, after 2025, curves are very heavily inverted. So how long can central banks increase the long end, so increase the short end rate without touching substantially their balance sheet? We know that the balance sheet has not really come down. Globally, the balance sheet of central banks is still stable. And even if you look at the Fed just by itself, it has only fallen marginally by not even 5%. So we think that here the elephant in the room is the balance sheet reduction, and it will come when central banks will get to the target rate, which, as the Taylor rule suggests in the US, is around 6–7%. So we're almost there. And once we get there, yes, we can keep the target rate higher for longer. But if inflation remains sticky, then the question will be around balance sheet reduction. So far, markets have been very relaxed about that, in particular because the BOJ has essentially delayed their decision to exit yield curve control. But the combination of yield curve control together with ECB QT, which has started, although relatively slowly, and additional potential balance sheet reduction by the Fed is something that will turn the trend in liquidity in the second half of the year. So even though in the first half of the year there were rate hikes in the short end, there was an expansion in balance sheets, in part also linked to the SVB facilities that were deployed to help regional banks. In the second half of the year, the tide for liquidity turns from a tailwind to a headwind. So we would expect more disinversion of the yield curve, and we would expect, in any case, more volatility in risk assets. In other words, even if you are not sure about quantitative tightening, what we know today is that there is a lot of exposure to duration, which has gone into markets because of imminent recession fears and because of historical exposures. And if the Treasury, 10-year Treasury goes above 4.5 or even above 4.25, a lot of investors, a lot of market participants will be in pain. And the second thing we know is that there's a lot of assets that are stuck in less liquid strategies. Take, for example, private debt with much lower yields than the liquid yields that are offered today, and this will need to reprice. So are we in an imminent recession? Are we in a tail risk environment? Probably not. There are some areas that are more fragile, and we already saw the regional banks in the US and Credit Suisse in Europe. Where are the next things that can break? Well, there's a lot of hidden risk in the non-mark-to-market areas of the financial system. But we are in essentially a slow repricing, a slow asset recession, which can accelerate if central banks start reducing their balance sheet, if inflation remains sticky. So what are the opportunities here in our view, and how do we capture them in our investment process, which, as you know, is based on three things. One is we start from the top down before doing the single name research. So we start from the top down, we go into sectors, then we go into single names. Number two, we always look for convexity over carry. There is a generation of credit investors that have been long carry. In a higher yield environment, that's something that will be challenged. And we've always looked for trades which can make more than one time the potential loss. We don't go and picking pennies in front of the railway track. Number three, speed of execution. That's very important. We were cautious in the first part of Q1. We turned long in March, but the window is very small very often. So it pays off to be nimble and to be fast and to be in liquid instruments. What we're seeing, again, is a slow motion stress cycle in credit. Higher for longer will unveil which capital structures are unsustainable, which companies and sovereigns cannot fund at 10% on a sustainable basis. In this context, we see the weakest part of the market is emerging markets, where governments were relying on low dollar, low Fed funds, and this has already been uncovered with several emerging markets stress situations this year. We think that more weakness is there, but there's a few value opportunities. Then the US high yield market is also more vulnerable, both because the Fed can be more aggressive and because corporates are more levered. We do think, in our models, we do expect defaults to rise towards 5% in US high yield over the next 12 months, and towards 3.5% in Europe. So more contained, more benign default environment in Europe. We think real rates need to go higher. Until a few months ago, investors were loading up on zero cash flow investments like crypto, art, or NFTs, and real rates are barely positive compared to where they were in the past before recessions happened. So the cycle still has room to run, and real rates can still go higher. So we do see more repricing of credit spreads, more dispersion, and a slightly higher default environment. But against this backdrop, you have a very longer maturity wall, lower leverage, and in some cases, sovereign support to companies. Many companies in Europe have got aid from the government. So essentially, looking at how markets are behaving and a tail risk in the market, which is really what we trade in credit, we had this long pause between 2012 and 2020. And there were very few tail events. This chart shows you the frequency and duration of tail events across different markets. And now we're entering a world where there's a lot more fragility. Tail events are more frequent, but they're also short-lived. And they're short-lived because central banks can intervene, and they don't want to break the system. They want to be able to continue with their policy without making the same mistake they made, for example, in 2018. So how are we positioned today? We are essentially going between mid-cycle and crisis in fundamentals, but markets sometimes are pricing Goldilocks. So I would say that in the US, we're definitely back to Goldilocks today, with spreads at very tight levels. In Europe, we have some pockets where we are in mid-cycle, so there are interesting opportunities. And in some selected areas and time periods, for example, in March in financials, we went into crisis. So we're always doing relative value in our strategy. And this year we've been up every month of the year, including this month. But obviously we shift from shorts to longs in proportion, depending on whether we see Goldilocks or crisis, and whether we see an expansion or a contraction in liquidity. And going towards the second half of the year, we probably will see more episodes of crisis, even though central banks will try to contain them. At the end, the question is really, can central banks achieve immaculate disinflation? Or is that just a policy free lunch? Well, they seem to say they can achieve it. We are skeptical. we think that real rates need to go higher, and the long end of curves needs to go higher as well, and that more things will break. But even if they don't, there's very interesting opportunities across different markets, because different parts of the world are in different stages of the credit cycle. So what do we like and dislike here? What are the best longs and shorts? We like to be very transparent with investors. So we've taken positions across European high yield since the end of last year. And here the view is defaults will stay low, even though corporate spreads widened, because we have better fundamentals and also government support in many companies. We added to banks in March and April, and we are taking some profits, but there's still some value, especially in countries that are going back to the investable universe. The investable universe is becoming smaller. China is out. A lot of emerging markets are out. But Greece, which has just seen, the PM Mitsotakis being reelected, is going back to investment grade this year, and banks are extremely wide. So that's another area where we see value. At the extreme positive, what we have seen over the past few days is that Ukraine might come back as well to the investable universe. Now, when we think about longs and shorts in our process, we always think about upside, downside, liquidity, sizing according to the potential loss, and ultimately we want a catalyst. So it's very easy to understand if names are good or bad in credit, but we're always looking for a catalyst to unlock that alpha. And sometimes the catalyst is top down, sometimes it's bottom up. In the case of Ukraine, there is a top down catalyst. There is willingness to pay. It's a very bondholder friendly environment. We don't like other stressed opportunities in emerging markets, but in Ukraine, there is willingness to pay. There's also ability to pay. There will be a lot of aid following a ceasefire. And with the last events that have happened over the weekend, we see that time is now running against Russia, not just against Ukraine. So we do see a more likely ceasefire over the coming months. These are all opportunities where gains are more than one time the potential loss. Tranches in a European high yield, which we bought for mezzanine in the low 40s last year. They're now in the 50s, and the equity bought in the essentially at 10 cents last year is now at 20 cents. This can go up more than 100% over the coming months. And Ukraine bonds are at 20 cents, which is where we bought them, a little higher than when we bought them first. But they can definitely double from here on a ceasefire and a debt restructuring. And now a quick intro on the shorts. There's a lot of capital structures that are going to be vulnerable, which have funded at 10%, funded at 5% or 4% in the past or lower, and now they have to fund at 10%. And we are always aware that we need to be able to stay in the trade, but there's a lot of interesting areas of the market which will look weak. And so, what do you think can break next, apart from after the banks, Adi?
So that's a great question. So if we think about the shorts, you can think about them sort of in two buckets. So one of them being, countries and capital structures which are unsustainable in an environment of very high rates. And then the other bucket effectively are, let's just say they're tail trades, where there's an extremely high payout in the event of either a recession or some kind of governance risk. So if we look at the first one, which is effectively thinking about which are the countries and the capital structures which are unsustainable in a high rates environment or a sustained high rates environment, which is how we're thinking about the next sort of year or 2 years playing out. Now, the last 10 years effectively have been an environment of carry. There have been a number of capital structures which have sustained themselves at say 1, 2, maximum 3%. And the reality is that at double those rates, they're basically free cash flow negative. And there's a wide spectrum of them. Now, on the most extreme side, the ones that have got the most amount of attention are things like commercial real estate, which, it's now become a sector that's extremely stressed. It was, 1 to 2% funding cost, now funding costs north of 7%. This is a trade we had on, we were shorted, we've taken profit on it, but it's not the only sector which is affected by essentially the same dynamics. So there's other sectors, things like, the telecommunication, the cable, as well as less covered when you look at things like debt collectors. When you looked at names like Intrum and Garfunkel, which are basically European debt collectors, funded themselves with about 3%, bought NPLs. The IR and the NPLs are going down. Concurrently, their own interest rates are going up. It becomes a free cash flow negative business. There are also countries that essentially cannot really sustain high level of interest rates. To put it, for example, I mean, Egypt, before the increase in interest rates, was funding themselves at 10%, and they were free cash flow negative, basically. Today, they'd have to fund themselves at 20%. They'd be even more free cash flow negative.
So essentially, the era of low rates has generated a lot of, zombies and companies and governments that were able to kick the can with very low interest rates. There's been an assumption so far that interest rates would just be high for a year and they would come down. If you imagine 5% for 5 years, then the picture changes drastically, because you have 5% risk-free and 400 or 500 basis points of spread on top of that. We think that's the environment where we are headed, and we have been spending a lot of time looking at the most unsustainable capital structures, the SPV type business models, and that goes beyond CRE or the REITs, which were in part repricing early on, but also, where there's value, which of these capital structures can unlock, in a restructuring some value, and which other ones are completely unsustainable. So the short side is also very interesting going into next year. We size trades and we pick parts of the capital structure which are convex, that are not very expensive to short, but contain a good amount of gains and offer a good amount of gains in a widening. And overall, we're very aware that this is a dance that central bankers are making with the market. They don't want to break the system, but clearly there will be some more areas of the system which, after many long years of low rates, will break. And with that, we're pretty excited to end the first half of the year and go into the second one. I'm going to turn it to Hope and see if there's any questions. Feel free to add them to the chat. Thank you.
Great, thanks. So again, yeah, if anyone has questions, please put them in the chat. I've got just a couple that I wanted to ask. We touch on this in a few ways during the conversation, but I'm curious about your thoughts on, maybe a recession is not imminent, but are we at potentially the start of a recession? So do you see one down the road? And heavily linked to that with the idea that interest rates, particularly long interest rates, may be a problem for, or longer term higher interest rates may be a problem for a number of the companies we mentioned. Do you see that, potentially we're going to enter some kind of distress cycle or distress period? And I know there's some cash on the sidelines that's looking for that and looking to take advantage of it. And so it's useful to hear your thoughts on that.
Okay, so actually we also had another question on default rates. Yeah. So the question is how are we going to see a big default cycle? And also the differentiation between the US and Europe. I mean, I know that there's a lot of investors, maybe more on the macro side, that have been positioning for 10% default rates in Europe. Why are not the European banks not blowing up? Why don't we have a recession this year? And the reality is there's still a lot of liquidity, and real rates are not very high, and banks are still lending. Consumers still have part of the COVID excess savings, but most of all, fiscal spending. Governments are spending at 7%. The US is spending at 7%. There's no mention of austerity. So consumer demand is solid. Unemployment is low. And there is still relatively loose credit conditions because the long end is way below inflation. So we see a slow-moving default cycle, and particularly a lower impact default cycle in Europe compared to the US, because European companies overall are better than their US counterparts, as are banks in general. Smaller European banks are better than the US regionals in terms of cap ratios. But obviously, the valuations that you have, might reflect partly that this view that there is especially last year, that there is a recession, that the Ukraine war is going to turn Europe into recession. So it's been an interesting part of the market to invest, with a lot of our fund compared to history, being a little bit more geared towards Europe. We don't always have that, but there's been much more interesting opportunities. So I mean, why are European companies better than US companies?
Feels like a loaded question, but
Yeah.
I think ultimately, so there are 2 points to make over here, right? Which is all getting to think of how do we make money from this. Fundamentally, when we look at the European credit indices, whether it's cash or index, it's generally made up of what are the largest companies in Europe, effectively quasi-state-backed companies. When we look at the equivalent in the US, they're much smaller names. You've got a much bigger concentration of what you might classify as sort of, small and medium type names, which we don't basically see in sort of the European high yield market in sort of the bonds. And so as a consequence, by definition, you tend to see a lower default rate in Europe than the US because of the composition of those indices. The thing to note is the fact that today, both of those indices are pricing more or less the same default rate, which is to say that essentially the fact that the market is expecting the European default large caps to have about the same level of default rates as the US mid caps. And being extreme, but it's essentially that, which is highly unlikely. And so therefore, this is an opportunity to make money.
Yeah, so basically it's index composition. It's the fact that in the US, a lot of triple Bs, issued in the investment grade market and a lot of triple Cs in the high yield market. So composition is worse in the US. It's not that we think European firms are better, but there's just higher quality in the index and more sovereign support. And also the ECB is less under pressure to hike above 5%. So it's a combination of these things. Europe is behind in the credit cycle. There's another question on our commercial real estate short. So we were short REITs in Europe. The US CRE has already played out to a large extent. We continue to trade REITs in Europe on the short side, but a lot of the move has happened. So we need to be very careful about being short all the time. And the reason is central banks will not want to create a massive recession. They don't want a sector to completely blow up, but REITs have repriced. When you are trading at 200 bips, there's definitely a short. When you're at 5, 6, 7, 800 bips, you need to be sure about the default rate of that specific company. So we're a lot more specific. And I think Adi mentioned, it's not a REIT, but it's a debt collector Intrum. They buy unsecured debt. It's a Scandinavian company. So they had Scandinavian funding costs on the liability side, and they bought periphery assets for a quarter of their book on the asset side. And they're now funding at 10%. It's not sustainable. So we do have shorts in the debt collection and in the REIT world, but they're a lot more selective now than they were before. We have another question on the BOJ and the yen.
Which I guess if you can expand the question, but I'm going to ask it back to you. But effectively, we saw the conference yesterday at Sintra, where we essentially had all 4 major DM central bankers discussing their view. And one of the things that was pointed out was the large variation amongst the 4, right? So you had obviously 3 that were more hawkish, 1 that was completely dovish, but even within the 3, there was quite a lot of dispersion. We had maybe it's a pause, maybe it's not a pause. Here's 50 bips, and we're going to do more. So I think the broader question is, how long can the Bank of Japan really continue to be the odd man in the room and stay so dovish?
Yeah, it was a bit funny because Lagarde said inflation is persistent. We have more ground to cover, and Powell said, every meeting is live, and we might do one, or we might do 1 hike per meeting or 1 every other meeting. I think Bailey was echoing Lagarde, and then Ueda said inflation is still low. And so, obviously it's not low today, but there is a structural issue with continuing to buy JGBs when inflation is above 4%. And I think the BOJ has given time for other central banks to do their job before rocking the long end of the curve. There is an interesting part of the financial stability review at the last one from the ECB, which actually says if the BOJ exits yield curve control, that's a danger to financial stability. So there is coordination across central banks, and if the BOJ acted too abruptly, it would actually hinder the process of normalization for the others. So the BOJ has waited, but eventually it's something that will come back later in the year, and obviously FX is adding to the pressure. So I think that, we don't have a timeline for the exit from yield curve control, but it's the what if that is really important in markets. And we've done a lot of work on who has duration exposure, essentially not just to JGBs, but to the rest of periphery, Eurozone bonds and treasuries. The BOJ was the anchor for long-term yields in the world, and it might not continue to do so, to be that anchor in the future. There is a couple of other questions. One question is about short-term rates. And the question is, do you think that higher short-term rates will eventually lead to a slowdown in consumption in the US? And the answer is yes. But, and this comes back to some of the work we've done on the different quartile of consumers. This impacts mostly the bottom 50% of the population, which unfortunately is only 20-25% of GDP. So it ends up hurting more people that are poorer. 98% of the population that has mortgages in the US has long-term mortgages issued pre-Fed hikes. 98% has mortgages that were issued before the Fed started hiking. So there's much less dependence on low interest rates, on short-end interest rates, front-end interest rates. This is research from Goldman Sachs. Here in the UK, things are a bit different. There's more repricing. Every quarter, there's a large percentage of the mortgage market, which is not long-term fixed. It's 3 to 5 year fixed that reprices. And so the transmission mechanism in the UK is much stronger from short-term interest rates to mortgage borrowers. Last interesting question here that I see is about there's two interesting questions here. It's one, what if inflation remains sticky forever? Well, that's something we are keeping into account. And what does sticky means? Does it mean 3% in the US, 3.5%? So this was actually asked at Sintra yesterday. Will central banks move their target? I mean, they cannot move their target now, so they will lose credibility. But eventually, there could be a situation where you don't really want to buy the Treasury 10-year at 3.8 if inflation stays at 3 to 3.5. So the long end, again, needs to reprice.
I think we would think about this in, ultimately, when we're thinking about macro, we're thinking about how to make money out of it. And when we think about inflation, there's 3 phases to central bank response. The first is sort of the interest rates, the second is the balance sheet, and the third is giving up, basically, right? So we're in thus far, we've effectively been in the interest rate hike environment, deciding, how long, how high, and so forth, and with very little tweaking on the balance sheet. Now, we need to sort of move to the second phase effectively at this point. Now, the question is, when do we move to the second phase, which is start and talk about the balance sheet and then wind of that faster. So to the question here, what happens if inflation is stickier for longer, or to put differently, what happens if in Q1 next year, we're still looking at inflation being sticky? At that point, the conversation of the balance sheet becomes much more live. It becomes much more relevant. And then, that's when we could have a more significant asset price correction because it's more directly linked to central bank liquidity.
Or they might not do QT and they might just tolerate higher inflation. But in any case, this could essentially start lifting the long end of curves. Yeah. We saw what happened in the end of May with the Bank of England talking about, quantitative tightening. Why don't we reduce our balance sheet a little bit more instead of hiking short-term rates, which is going to hurt mortgage borrowers. And then, yields started moving up. So generally, our view is that the higher for longer environment and the risk of sticky inflation has not gone through pricing in credit markets, not filtered through all the capital structures and all the rates markets and credit markets, and even equities to some extent. Can the economy live with higher rates? Yes, and actually maybe they're a good thing. They can reallocate capital, can help to reallocate capital from inefficient sectors like crypto or unproductive assets like real estate into producing assets. But in the reallocation process, there will be bumps and there will be opportunities. So that's generally our view. In this context, there is a risk in non-mark-to-market securities, particularly private debt and private equity. We continue to see investors, having larger allocations there, but yields being subpar compared to what we see in the liquid market and in liquid strategies. That is a slow moving repricing, similar to real estate. It's sticky. There's few sellers on the market, and then there's price discovery, but it lasts for a while. So I think we are, still at the beginning of this slow-moving repricing of this higher for longer environment. Large chunks of markets and economists are still hoping for, a pivot and or seeing a recession, which will lead to substantial rate cuts. But again, central banks will not have the same room as before. So will we have in the future, low nominal rates? I don't think so. I think we're more likely to have, slightly higher nominal rates and inflation at a slightly higher level. So we're, more likely to have a treasury at 4.5, and inflation at 3 than we are to have, rates at 1% and inflation at 2, in my view. And that changes a lot the picture for high debt, highly levered cap structures. And finally, there's a question on AI, which is everywhere. We have been, over time, we've been looking at the tech sector, and currently we do see a pricing which is Goldilocks for that. There are certainly deflationary forces in play in the long run. Part of them are demographics, part of them are due to technology, but the timing, I think, that the market is pricing on these forces is very quick. It's quicker than we might see. So in my view, the way I see things here is the investable world has become smaller. China is probably no longer investable. Emerging markets, many of them, are no longer investable. And so investors are funneling part of their cash into equities, which are seen also as a safe haven. And part of that is in the US market. So we continue to see, strong dollar. We continue to see weakness in emerging markets. We continue to see credit capital structures repricing. But this will also unlock, substantial value. And, we wouldn't go into the S&P at 4,500 close to, which is where we are now. We see a lot better value in, credits at 10% or above 10%, which has, on a risk-adjusted basis, especially, which have, half the volatility of equities here. But obviously, it's very important to trade these credits tactically, because there are pockets of volatility in the market. There are moments of illiquidity, like March, there will be more. And because central banks have less room to save everyone, to save the market in the future. So we're going from an environment where there was low volatility and there was buy the dip and there was beta, to an environment where, being nimble, being tactical, pays more, and rather than committing your capital to a private debt fund for 5 years, being tactical, we think is the road for our performance in the future. I think we've exceeded our time, but we're really happy to take on your questions on email going forward, and very happy to continue the discussion with you. Thank you. Thank you so much for your time.